Welcome back. The capital employed by any company comprises of the long-term loans plus the shareholders' equity. For this company, the interest on loans is 5%, which is taken net of tax, because as you know, interest expense is a deductible expenditure for tax purposes. And the expected return of shareholders is 15%. Now, this expected return is nothing but the dividend expectations of the shareholders, the growth percentage that they see in the company, etc. That is how this figure has been arrived at. Now, if out of the total capital employed by the company, half of it is loans and half of it is shareholders' equity, then what is the average cost that we are incurring on these funds? It is 5% divided by 2 plus 15% divided by 2. Or on an average, we are incurring a cost of 10%. This is known as the cost of capital. More specifically, it is known as the weighted average cost of capital. Now here, you don't need to understand how this cost of capital has been calculated. Just understand the meaning of cost of capital. What is the meaning of cost of capital? It is the cost that the company incurs for the funds that it has borrowed, either by way of long-term loans or by way of shareholders' equity. Since the cost is 10%, the profits made out of this capital invested should definitely be above 10%, or the target return on investment, also known as the target ROI, should be greater than or equal to the cost of capital. So in short, cost of capital is the minimum return that the company has to generate out of its capital. Only then their lenders and shareholders will be happy. Now, the company can fix this target return at a rate higher than the cost of capital also, because at times it may need funds for major corporate expansions, etc. But cost of capital is the minimum return that it should generate. So what is the situation out here? On one side, you have Division A, which is an investment center. That is, the divisional manager has the authority to invest the funds of the company. And on the other side, you have the company or the head office, where the cost of capital is 10%. So their target return on investment should be greater than or equal to 10%. Now, since Division A is an investment center, this target return on investment will be fixed by the head office for that particular division, and it will evaluate the performance of the division. Basically, there are two methods of evaluating any investment center. One is a return on investment method, and the second is a residual income method. So we will start off with the return on investment method. Now, before learning the formula of return on investment, we need to know the meaning of certain terms. One is controllable profit and the other one is traceable profit. So what is given here is the division's statement of profit or loss. So you have the revenue, and from the revenue, when you reduce the cost controlled by the divisional manager, you get the controllable profit. And from the controllable profit, add or less the non-controllable income or expenses, or those income or expenses controlled by the head office, then you get the traceable profit related to that particular division. From that, you reduce the apportioned head office cost. That is, the head office will incur certain common expenses for all the divisions. So there will be a logical way in which the head office costs are apportioned between the various divisions. So that is deducted finally to arrive at the divisional profit. Now, for assessing the division, you have to consider the traceable profit. You definitely cannot consider the apportioned head office cost because that is strictly not based on the performance of that division. And for assessing the divisional manager, it is the controllable profit which has to be taken, because there might be certain non-controllable items like a marketing campaign is being done by the head office. So the divisional manager is not responsible for its spending. So it is actually unfair to treat all those non-controllable expenses and income for evaluating the divisional manager. Now let's learn the formula of return on investment. So ROI, I said for assessing the division's performance, what should we take? We should take the traceable profit. And return on investment is traceable profit divided by capital employed into 100. So what are we trying to find out? If the traceable profit is say 20 and the total capital employed is 100, then the return on investment is 20%. Now, what do you mean by capital employed? Capital employed, I already said that it is long-term loans plus the equity. Now, this long-term loans plus the equity is the liability side. So if you work out from the asset side, it is also equal to the total assets minus the current liabilities, because both are the same. Now coming to assessing the divisional manager's performance. The divisional manager is evaluated based on the controllable profit. Instead of traceable profit, you have to substitute it with controllable profit. For what? For assessing the divisional manager's performance. So the formula is return on investment is equal to controllable profit divided by controllable capital employed into 100. Now, you would have noticed that the word controllable has come in front of capital employed. Now, what exactly does this controllable capital employed mean? It means the capital which is under the control of the divisional manager, or the investments which the divisional manager has made on his own. Suppose the head office buys a vehicle and just transfers it to the division. So it is not an investment made by the divisional manager. So you have to exclude those vehicles because it's not a controllable asset, because the head office will be free to sell the asset as and when it pleases. You cannot evaluate the divisional manager based on assets that he cannot control. So it is just that the capital employed will exclude all non-controllable assets. It will be specifically mentioned in the question, what are all the assets that are not controllable by the divisional manager? So you don't need to crack your head for that. And if the current return on investment, that is a calculated return on investment, if it is greater than the target return on investment, then the performance is good. Now, let me just elaborate on the traceable profit and the controllable profit. Now, the traceable profit is usually taken as the earnings before interest and tax. Why before interest? Because the target return on investment is the profits generated before deducting this interest. How did we calculate the target return on investment? The target return on investment was calculated based on the cost of capital. That is the cost related to the interest and the cost related to the dividends, which means that the target return on investment is itself the profit before deducting this interest. That is how we have calculated the target rate. So when the target rate is a rate before deducting interest, then when we are calculating the current return on investment, that should also be a profit before interest, correct? That is why the traceable profit is always taken as the earnings before deducting interest. And the next part, it is also earnings before tax, because usually we ignore the tax element as far as the division is concerned, because the tax itself is generally done at the corporate level. So for evaluating a particular division, we usually ignore the tax element which is related to that particular division. Now, earnings before interest and tax, we will shorten it and we will write it as EBIT. Further, what else are we excluding? We are not taking the apportioned head office cost while calculating the traceable profit. So the traceable profit will always be earnings before interest and tax before reducing this head office cost. So whenever you get a profit and loss account, how do we arrive at the traceable profit? It is usually the earnings before interest and tax before reducing the head office cost. Now coming to the controllable profit. Controllable profit is a level up, which means that what have they excluded? They are excluding the non-controllable income and expenses, or those income or expenses which are controlled by the head office. So the controllable profit is earnings before reducing the head office cost, that is actually the traceable profit, and also excluding the non-controllable expenses and income. The statement of financial position is given with assets totaling 3,400 and equity and liabilities again totaling 3,400. Then there is a statement of profit or loss, revenue, less operating cost giving the operating profit of 500, less interest paid giving profit before tax of 420. The cost of capital for the division is 10% per annum and the interest on long-term loans is 5% per annum. And head office decides the division's capital structure. This is the picture that I had showed you earlier. See, the cost of capital was 10% and the interest rate was 5%. Key thing that we have to take note is the cost of capital of 10% because we need the weighted average cost of capital. The interest rate of 5% is not required for any calculations. Now, we have studied that the target return on investment should always be greater than or equal to the cost of capital. But in this particular question, the head office has not specified the target return on investment. So we can very safely take the target return on investment as the cost of capital at the rate of 10%. Now, they have asked us to calculate the return on investment and evaluate the performance of the divisional manager. For assessing the divisional manager's performance, the formula is controllable profit divided by controllable capital employed into 100. And what is controllable profit? It is earnings before interest and tax, before reducing the head office cost and excluding the non-controllable expenses and income. But in the question, head office costs were not there and non-controllable expenses and income were not specified in the question, which means that the controllable profit is equal to the EBIT or the earnings before interest and tax. So let's look into the figures provided. Earnings before interest and tax. Here they have said it is profit before tax. And this is the interest paid. And interest, as you know, the capital structure is completely controlled by the head office, which means that we have to take the earnings before interest and tax or the operating profit as the controllable profit. And what is a controllable capital employed? Controllable capital employed, the only thing is that you have to exclude all the non-controllable assets or the assets that cannot be controlled by the divisional manager. In the question, there were no non-controllable assets which were given. It was a fairly simple problem. So, controllable capital employed and capital employed is the same thing. You don't need to exclude anything simply because there are no non-controllable assets given in the question. And what was capital employed? Capital employed is nothing but long-term loans plus the equity or the total assets minus the current liabilities. So I've just copied the formula of capital employed. Now, long-term loans is 1,200 and equity is also 1,200. So the long-term loans plus the equity is 2,400. Alternatively, you could also take total assets 3,400 minus current liabilities 1,000, wherein you get the very same answer of 2,400. So we have got the controllable capital employed here. And what is a controllable profit? That was nothing but the EBIT. So 500. We get the answer as 500 divided by 2,400 into 100, or the return on investment is 20.8%. And what was our target return on investment? That's just 10%. So we will write the final analysis. Since the current return on investment, which is 20.8%, is greater than the target return on investment, which is nothing but 10%, the manager of Division A is performing well. So this was the simplest problem in ROI. Now we will add a few more items to this question so that we will get an idea of how to deal with non-controllable expenses and income. So continuing the same problem, this is the additional information. Operating costs include marketing expenses controlled by head office. Any expenses controlled by head office will be specifically given in the question. So here again, it is specifically given. And depreciation on non-current assets controlled by head office is 10. So there are two non-controllable expenses. Whenever there is a depreciation on non-current assets controlled by head office, the question will definitely specify the non-current assets controlled by head office, and that's equal to 100. In this particular question, when compared to the previous question, we have got just two additional information, and that is non-controllable expenses have been given and non-controllable assets have also been given. The formula remains the same. ROI is controllable profit divided by controllable capital employed, and controllable profit excludes the non-controllable expenses and income. And as far as the controllable capital employed, yes, we have got some non-controllable assets as well. So it is just these adjustments that we have to make to arrive at the answer. So first we will arrive at the controllable profit. Controllable profit, first we will take the EBIT, that is 500. And then we have to exclude the non-controllable expenses and income. So in this particular case, there are two expenses, 20 and 10, which is included in the operating cost. So we have to add back because already that is reduced. So add back the expenses controlled by head office. This is nothing but the non-controllable expenses as far as the divisional manager is concerned. So we have to add 20 and 10. So 30 we are adding back to the EBIT to get the controllable profit as 530. All that we are doing is we are excluding the non-controllable expenses and income. In this case, there are no income, there are only expenses. So we are adding back. For expenses, we have to add back. And for non-controllable income, we have to reduce. And as far as the controllable capital employed is concerned, what was the formula? Long-term loans plus equity is a normal formula for capital employed. From that, you have to exclude the assets controlled by head office. The alternative formula is you can take total assets minus current liabilities. But the only thing is, again, you have to reduce the assets controlled by head office. So we know the capital employed was 2,400. That is nothing but the long-term loans plus the equity. And the non-current assets controlled by head office is 100. So 2,400 minus 100, you will get the controllable capital employed as 2,300. So we've got all the details concerning the return on investment. Controllable profit is 530. And controllable capital employed is 2,300. So the answer works out to 530 divided by 2,300 into 100, or the ROI is 23%. Now, before doing the final evaluation, let me make a point clear. Now, just look at this additional information. Operating costs includes marketing expenses controlled by head office 20. And what are we doing? We are adding back the expenses. That is, we are not penalizing the divisional manager for an expense which was not under his control. That is the logic behind adding back this 20. But there is an other side to it. Now, because of this marketing expenses incurred by the head office, the revenue of the division would have increased. So what is happening here? The divisional manager is not penalized for the marketing expenses controlled by head office. That is, we are excluding that. But he is getting benefit of the additional revenue relating to this marketing expense. The logical method is, if you are excluding the expense, you have to exclude that income related to that expense also. Only then the comparison will be meaningful. But unfortunately, in this question, the income related to the marketing expenses controlled by head office is not given. So we will make a note. Due to the absence of information, revenue related to the marketing expenses by head office has not been excluded from the controllable profit. So here again, what is the evaluation? The return on investment is 23% and the cost of capital is just 10%, which means that the divisional manager is performing well. Now let's look into the advantages of the return on investment method. The first advantage is it is easy to understand and it is widely accepted as it is the same as return on capital employed, which is used to assess the overall business performance. Now, return on capital employed and return on investment, the formula is the same. The only thing is return on capital employed is calculated for the company as a whole, and return on investment is calculated for the division. So since it is very similar to return on capital employed, it is very easy to understand. The next advantage is it enables comparison between divisions of different sizes as it is a relative measure or it is measured in percentage. Say there are two divisions, Division A and Division B. The profits of Division A is 50 and that of Division B is 400. Now, if you look at profits alone, we will think that Division B is performing better than Division A. Now, let's calculate the ROI. So the capital employed of division A is 500 and that of division B is 5,000, which means that division B is a much bigger division when compared to division A. Now, what is ROI? ROI is nothing but profits of that division divided by capital employed, or it is 50 divided by 500 into 100 for division A, and for division B, it is 400 divided by 5,000 into 100, which means that the ROI for division A is 10% and that of division B is just 8%. It is division A which is performing better than division B because it has managed to generate a profit of 10%. But division B, it had a higher capital of 5,000 and the profit percentage that it could generate on its capital was just 8%. That is what is mentioned in the second point. It enables comparison between divisions of different sizes as it is a relative measure. Now moving to advantage 3. There is scope for detailed analysis. Return on investment is profits divided by capital employed of a particular division. Return on investment can also be written as profit divided by sales multiplied by sales divided by capital employed, because sales and sales gets cancelled and you ultimately get profits divided by capital employed. Profits divided by sales is nothing but the profit margin. That is the profit that we were able to generate on each rupee of sales. And asset turnover ratio is nothing but the sales generated for every rupee of capital employed. So actually we can have a detailed analysis whether the margins of the product is good and whether the capital has been fully utilized to increase the sales. Now let's move on to the specific disadvantages of return on investment. It may lead to dysfunctional decision making. Suppose the target return on investment is equal to 10%, which is the cost of capital, and presently the division has got a controllable profit of 500, capital employed of 2,000. So the ROI will be 500 divided by 2,000 into 100 or 25%. Now a new project comes up. They have got a controllable profit of 150. Capital to be employed for the new project is 1,000. So the new project's ROI will be 150 divided by 1,000 into 100 or 15%. Now this new project's ROI, since it is 15%, which is greater than the cost of capital, rightfully the manager should accept the project because it will be beneficial for the company. But just look at the combined return on investment if the new project is accepted by the divisional manager. Controllable profit will be 500 plus 150 equal to 650. Capital employed will be 2,000 plus 1,000 for the new project, which is equal to 3,000. So the combined return on investment will be 650 divided by 3,000 into 100 or just 21.7%. Now, usually the bonus of the divisional manager is dependent on the ROI. Higher the ROI, higher will be the bonus. So, even though this new project is beneficial for the company because it exceeds the cost of capital, the divisional manager will reject the project because it will lead to a drop in the ROI. That is the meaning of the sentence, may lead to dysfunctional decision making. That is, when the return on the new project is greater than the cost of capital, but the return on the new project is less than the existing ROI. So this is one of the main disadvantages of ROI. So because of this disadvantage, it is better to adopt the second method of evaluating a division, the residual income method. Unlike return on investment, which is calculated as a percentage, residual income is calculated in dollar. You take the profits of the division in dollar, and from that, you reduce something called the notional cost on capital. What do you mean by notional cost on capital? It is nothing but the amount that is to be paid as interest for the loans and also as dividend for the shareholders. So the profits in dollar minus the notional cost on capital, again calculated in dollar, is known as the residual income, which is also a dollar amount. Now, if from the profit we reduce the notional cost on capital and we are left with a positive figure, then it means that the division is performing well because the profits is higher than the amount that is to be paid as cost on capital. The question that may arise in your mind is, how do you calculate the notional cost on capital in dollar terms? Simple. You just take the capital employed multiplied by the cost of capital percentage. In the visuals that I had showed you earlier, it was 10%, right? See, earlier we had calculated the weighted average cost of capital as 10%. So we have to take this percentage, that is 10%, and multiply it with capital employed. So capital employed multiplied by the cost of capital percentage. In the visual, we had calculated it at 10%. So naturally, we will get the cost of capital in dollar amount. So that is what you have to reduce to get the residual income. Now, there could be one more situation. Sometimes the head office wants a return of more than 10% from the division. Say they have fixed a target of say 12%. Why are they fixing it at a higher rate? Maybe they want funds for expansion, etc. So that is why they are fixing a higher target that is more than the cost of capital. Then naturally, you have to multiply the capital employed with the target return on investment percentage. Now, a popular doubt among the students is, in a question, if the cost of capital and the target return on investment is given, then which should be taken to calculate the notional cost on capital? So I've just copied the technical article that appeared in the ACCA Global website. Imputed interest is another name for notional cost on capital. Imputed interest is calculated by multiplying the investment. The investment is nothing but the capital employed by the cost of capital. This is typically the weighted average cost of capital. However, instead of using the weighted average cost of capital, a company might also set a target return on the capital provided. So they can also set a target return. In such a situation, a positive residual income will indicate a division is generating a level of return greater than the target. So what they are saying is, if you're taking a target return, then it means that a positive residual income will indicate that a division is generating a level of return greater than this target. If you're taking cost of capital and you are ending up with a positive residual income, then it means that the profit is generating an income greater than the cost of capital. So whenever the target return on investment is specifically given in the question, then for evaluating the division, it is advisable to take this target return because that is what is specified by the head office. There is nothing wrong in taking the cost of capital also, because then the evaluation will be whether the profit is sufficient to meet the cost of capital alone. But ideally, it is better to evaluate whether the profit is sufficient to meet the target returns that is specified by the head office. That is the difference between the two terms. So it is either the cost of capital or the target return on investment. If the target return on investment is specified in the question, then we have to take this. If this is not given in the question, then we can definitely take the cost of capital percentage. So I've just copied the formula into the next slide. Now we will elaborate it a bit further. Now, when we calculated the return on investment, we studied that the divisional manager is always evaluated based on the controllable profit, and the division is evaluated based on the traceable profit. And regarding the capital employed, the divisional manager was assessed based on the controllable capital employed. So the very same calculations apply here also. So the controllable or the traceable profit and the controllable capital employed is calculated in the same way as for return on investment. For assessing the divisional manager's performance, for this profit, which profit should you take? You should take the controllable profit. And for this capital, which capital should you take? The controllable capital. So we will just modify the formula. So profit is the controllable profit and notional cost on controllable capital employed. Now, when we are assessing the division's performance, then what profit should you take? You should take the traceable profit, correct? So it is the traceable profit minus, again, here there is no change, notional cost on capital employed. It is only for the divisional manager we take the controllable profit and the controllable capital employed. So this is the same problem that we had tackled while calculating the return on investment. The controllable profit, the capital employed, everything remains the same for the return on investment and also for the residual income. So I'm not going to explain that again. And the cost of capital is 10%, which is itself the target return on investment, because the target return on investment is not specifically given in the question. For assessing the divisional manager's performance, what is the formula for residual income? Residual income is equal to the controllable profit minus the notional cost on controllable capital employed. So controllable profit, we know it is 500, and the notional cost of controllable capital employed is the controllable capital employed multiplied by the cost of capital. In this particular question, the controllable capital employed and capital employed is the same. That is why I've written capital employed. So capital employed, when we calculated ROI, we found that it is 2,400. That is 1,200 plus 1,200. That's the equity plus the long-term loans. So calculating notional cost of capital, it is 2,400 multiplied by 10%, or it is 240. Now calculating the RI, controllable profit is 500 and the notional cost is 240. So we are left with a positive residual income of 260, which means that the divisional manager is performing well because the controllable profit exceeds the cost of capital. So the evaluation is, since the RI is positive, divisional manager is performing well. Now moving to the second question. So this question is also the same question that we did for calculating ROI. So the way in which we arrived at the controllable profit, the controllable capital employed applies for residual income as well. So I'm not going to explain that. This is just the details that I have copied from the question tackled earlier. So the key points that have been calculated, I am going to copy into the next slide. The target return on investment is 10% of the cost of capital. The controllable capital employed is 2,300 and the controllable profit is 530. These are the three information that have been copied from the previous slide. Now we will go to the calculation of residual income. Residual income is controllable profit minus the notional cost on controllable capital employed for evaluating the performance of the divisional manager. Controllable profit, we know it is 530 and the notional cost is controllable capital employed multiplied by the cost of capital percentage. The controllable capital is 2,300. The cost of capital is 10%. So the notional cost is 2,300 multiplied by 10%, which is 230. So now we can calculate RI. Controllable profit 530, notional cost 230. So the RI works out to 300. Again, since the RI is positive, the divisional manager is performing well. Now let's move on to the advantages of residual income. The main advantage is it prevents dysfunctional behavior. A new investment might add to the residual income, though it reduces the ROI. Now you would remember the example that I had cited as a disadvantage for ROI. I will just refresh your memory. Division A existing ROI was 25%. The new project's ROI is 15%. Though it is greater than the cost of capital of 10%, even then the combined ROI will be 21.7% only. Because of this drop, since the bonus of divisional manager is getting affected, the divisional manager will reject the new project. This was a disadvantage of ROI. Now, if the same project is calculated under residual income, we will see the outcome. Now, residual income, we know it is controllable profit minus the notional cost on capital. So we will calculate RI for division A before investment in the new project. So it is 500, which is the controllable profit, minus 2,000, which is the capital employed, multiplied by 10%, which is the cost of capital. So the residual income comes to 300. Now we will take the residual income of the new project. It is 150, which is the controllable profit, minus capital employed 1000 into 10%. So the residual income comes to 50. Now we will take the combined residual income. So it is 650, which is a controllable profit, minus capital employed 3000 multiplied by cost of capital 10%. So we get the residual income as 350. So compared to the earlier stage of 300, there is an increase of residual income to the tune of 50, and we get 350 as a residual income after the investment, which means that if the divisional manager is evaluated based on the residual income, then it shows an increase, unlike that of return on investment, where it will show a reduction. So that is why it is said that it prevents dysfunctional behavior. Now, moving to the second advantage, making a specific charge for interest helps to make the investment center managers more aware of the cost of the assets under their control. Now, while calculating the residual income, we give a dollar amount for the notional cost on capital. This helps the manager to be aware of the cost of the assets under their control. Now, moving to the third advantage, different interest rates for the notional cost of capital can be applied to investments with different risks. Now, it is not necessary to take this 10%, which is a cost of capital, and get the residual income. If the new project is very risky, instead of 10%, the company could fix an increased return, say of 13%, based on the riskiness of the project. So that is what is mentioned in point 3. Now moving to the specific disadvantages of residual income. Do not facilitate comparisons between divisions, since the residual income is dependent on the size of the divisions. Now, while discussing the advantages of return on investment, we saw that the return on investment facilitates comparison between two divisions of varying sizes. But if you take residual income for comparisons, then it will not work out properly. I will show you why. Now, residual income for division A is $50, which is the controllable profit, minus the capital employed of 500 multiplied by 5%, which is the target return on investment percentage. So the residual income is 25 for division A. And as far as division B is concerned, the residual income is 400, which is the controllable profit, minus 5,000, which is the capital employed, multiplied by 5%, which is the cost of capital or the target return on investment. So you get the residual income as $150. Now we get the impression that division B is performing much better than division A because of the increase in the residual income. But is that the case? It is because division B has got a higher capital. That is the reason why it was able to generate a higher residual income. But when we looked into the return on investment of both the divisions, we saw that division A is performing better than division B. It is generating return at the rate of 10% for the capital employed, when division B was generating just 8% for the capital employed. So naturally, division A is performing better, but that is not brought to light while calculating residual income. Now I will show you the disadvantages which are common to both the ROI and the RI. ROI and RI increases with the age of the asset if carrying values are used. Carrying values means the written down value of the asset, that is after depreciation. So managers may be reluctant to replace old inefficient machines. Now the target return on investment is 10%, which is the cost of capital. Now in the current year, the controllable profit is 500, capital employed is 2000. So the ROI will be 500 divided by 2000 into 100 or 25%. And the RI will be 500 minus capital employed 2000 into 10%, which is 300. Now, if the divisional manager retains the existing asset, then we will see the situation. So next year, you're retaining the asset. Say the division has made in and around the same controllable profit. So the capital employed will witness a reduction because of the depreciation on the fixed assets. So it is reduced to 1,800. Now we will see the revised ROI. ROI will be 500 divided by 1,800 into 100 or 27.7%, and RI will be 500 minus capital employed 1,800 into 10% cost of capital or 320. See, because the existing asset has been retained, the capital employed has reduced because of depreciation. So what is the end result? The ROI and the RI has increased without the divisional manager putting in any extra effort. Now take the reverse situation. If next year he decides to replace the machine. So even here, we will assume that in and around the same profit has been maintained. So 2,000 is a capital employed and you are selling the existing asset and you are buying a new asset. The new asset will definitely have a higher price. So net effect, the capital will increase. Say the capital has increased to the tune of 500. So the revised capital employed because of replacement of the asset is 2,500. Now we will see ROI and RI. ROI will be 500 divided by 2,500 into 100 or 20%. And RI will be 500 minus capital employed 2,500 into 10%, giving an RI of 250. So just because the divisional manager has replaced the asset, the ROI and the RI has dropped. So what is the end result? Even if the machine is old and it is time for replacement, the managers will not replace it because they don't want the ROI or the RI to reduce. So managers may be reluctant to replace old, inefficient machines. May encourage fraudulent manipulation of profit and capital employed figures to improve the results. Example, in order to meet the bonus targets. Bonus, if it is dependent on the ROI or the RI, they will manipulate the profits. At the year end, they will make a fictitious sales and they will increase the profit. And next year, they will reverse the sales and treat it as sales returns. So that is actually a bogus entry which is taking place just to inflate the profit. So this is also a common disadvantage. Moving to the third disadvantage, different accounting policies can confuse comparisons. Example, depreciation policy between companies. Now, because of the difference in accounting policies, the ROI of one company may not be comparable with the ROI of another company. Now, point number 4, short-termism. Managers may reject the investments with a positive net present value and high payoffs in later periods. Now, a new project is coming up. Maybe it is only in the 5th or a 6th year that particular project will generate very high profits. But in the initial 4 years, that project might be suffering a loss. So in the long run, project will be better because of the higher payoffs in the later periods. But you know what the managers will do? That first 4 years, their ROI and the RI will suffer because of these losses of the new project. So even if the project gives high payoffs in the later period, they will reject that project. So that is what is mentioned in point number 4. Managers may reject investments with a positive net present value and high payoffs in later periods because they initially have an adverse impact. As a result of this capital expenditure, the ROI or RI may reduce in the initial years. Now, moving to the next disadvantage, single factor measures such as ROI and residual income are unlikely to give a full picture of the divisional performance. You should use balanced scorecard where there are multiple perspectives, like you should look into the customer perspective, you should look into the internal business processes. So just by depending on just one measure, that is ROI or RI, you will not get the correct picture of that division. And the last disadvantage is difficulty in estimating the cost of capital. Now that figure may not be easily available. So we are done with ROI and RI. We have covered all the major points, but practice is the key. I request all the students to work out the problems from the exam kit so that you will get a firm hold of the topic. Now, before we wind up, let's move on to the final recap.